You've probably heard financial influencers say that the US stock market typically returns about 10% per year. And that's true if you average across more than a century of data. But what often gets left out is that this number smooths over some very long and painful stretches. The so called 10% average hides the fact that there have been entire decades where investors actually lost money after inflation. In other words, their purchasing power shrank even while they stayed invested. Let's look at the three worst 10-year periods in US stock market history, starting with the third worst. From 1999 to 2009, investors lived through the bursting of the dot-com bubble and then the global financial crisis. After accounting for inflation, investors lost about 36% of their wealth over that decade. This is often called the lost decade. The second worst stretch came during the 1970s stagflation era. From 1966 to 1976, stocks were choppy but didn't collapse outright. The real destroyer of wealth was inflation. Prices rose so quickly that even though stock prices looked flat in dollars, investors' purchasing power fell by about 37%. And the worst 10-year stretch of all time came during the Great Depression. From 1929 to 1939, stocks crashed nearly 90% at one point, and while they partially recovered by the end of the decade, investors were still down about 43% in real terms over that 10-year span. So yes, the US stock market has delivered roughly 10% annualized over the long haul, but that's not a promise for every 10-year period. The data includes long stretches of negative real returns, decades where patience was tested and wealth eroded. The lesson isn't to avoid the market altogether, but to recognize that averages can mask volatility. Time in the market matters, but so does the resilience to stay invested through the worst times.